Benjamin Franklin said there was only two things certain in life, death and taxes. When I finished dental school, I accepted the fact that I was going to pay a boatload of taxes over my career. I'll never forget the conversation I once overheard at a Christmas party. It was actually between two doctors arguing who made the most money based on the amount of taxes they paid. It went something like this. Dr. A, man, can you believe I paid over $350,000 last year in taxes? Dr. B, man, that's nothing. I paid the IRS over $600,000. Now, as a green periodontist at the time, I thought to myself, you have to be making some serious money with a tax bill that high. Little did I know that there was a way to make more money by working smarter, not harder, which is exactly what we're going to cover in this video today. If you're new to this channel, I'm Dr. Jeff Anzalone, a periodontist that's on a mission to get you out of the rat race by lowering your taxes and passive income creation. You can download the passive income guide I've put together for you below the video. Now, isn't it a shame that we go through our entire career focused on working more in order to increase our income? This could be either working longer hours, more shifts, but what are we doing? Inevitably, we're constantly trading more of our valuable time for money. Sound familiar? Now, once I learned how real estate investors operate, I realized that not only could I begin replacing my dental income with passive income, but I'd also receive unbelievable tax deductions such as depreciation. Look, I'm not a tax advisor, so if you have tax questions, consult yours, specifically one that's knowledgeable when it comes to real estate. You don't have to have a professional degree like a law degree or medical degree in order to learn how real estate can lower your tax bill. There's tons of ways, there's tons of resources that you can get online. Now, one of the secrets that wealthy real estate owners use to seriously lower their taxable income is something called, what we're going to talk about today, a cost segregation study. So let's dig a little bit deeper and find out what this is about. So, question, how does a cost segregation study work? Well, this study identifies and reclassifies personal property assets to basically shorten the depreciation time for taxation purposes, which basically reduces the current income tax obligations. So basically the primary goal of a cost segregation study is to identify all the building costs. Let's say you got an apartment building. So that goes in and cost segregation. It segregates out. It identifies all the different building costs that can be depreciated or written off over a shorter tax life, typically 5, 7, or 15 years versus what it normally is, 39 years. So typically it's 39 years for commercial building, commercial real estate, and it's 27.5 years for residential real estate. All right. So example, here's the 5, 7, and 15-year example. So these are broken down into what they call tax life components. So in a 5-year tax life component, this is tangible personal property. And this is things like carpeting, decorative lighting, cabinets, ceiling fans, things like that. In the 7-year tax life components, you're looking at basically all the telecommunication related systems, whether it's cable, telephone, things like that. And then in the 15-year, this is anything that has to do with land improvements. This could be parking lots, driveways, sidewalks, curbs, landscaping. They want to build a pond out there, throw up a flagpole, whatever. Now, these personal property assets, they generally include items that are affixed to the building, but they don't relate to the overall operation and maintenance of the building. Okay. Now, the three things that reducing the tax life can do is going to help accelerate your deductions. It's going to give you a reduced tax liability, and more importantly, it's going to increase your cash flow. So all these different deductions, they only count the value of the building. They do not count the land. So the land is not into this factored into this study. All right. So now, can you go out and do this on your own, or who performs these? Well, typically, somebody that wants to do this on their own, it's not too feasible. Usually it's a team approach, and it's a team of tax advisors, and it's a team of engineers. They actually work together, And then they decide which of the building components should go into each of these categories, and then how much each element costs on its own. Next is what are the property types that are qualified for this study? Pretty much any type of commercial property out there, or hospitality, apartments, hotels, retail, office buildings, medical buildings, self-storage, R&D, research and development centers, restaurants, manufacturing facilities, you name it. All right, so I remember when I first sat down with my accountant and he was talking about, hey, we're going to do a cost segregation study of your office, and then we're going to look at your depreciating some of your dental equipment and supplies and this and that. And man, when I got out of school, I didn't have a clue what he was talking about. I don't know about you. I was just kind of like nodding, yeah, yes. But I really wish he would have explained it, or I wish accountants would explain this more. And that way we could get more involved with being more proactive. Maybe I would have done something differently had I known they were looking at, depreciating this quicker, in this section 179, where you can take all your depreciation up front on, different things to help the planning. So if you're trying to decide on, you're going to buy some equipment or new technology, taxes are a big part of it. So I really wish that they would get us more involved, which is why I'm trying to get you more involved with this, instead of just looking at, hey, I'm just going to invest in real estate. It's going to give me some cash flow. But something like this changes the game, because both you and I know we're paying a ton of taxes, and anything we can do to legally lower it, the better. So what better way to talk about this and give a specific example? All right, let's talk about Dr. R. Dr. R is going to invest, wants to start getting out of his practice. He wants to get into real estate. So he finds a medical office building that's churning and burning, and there's a practice there. So he invests in this office building and plans to sell it in 5 years. He pays $900,000 for it. All right. So he kind of knows a little bit about cost segregation and taxes, talks with his accountant, and they actually go in and they start figuring this up. They say, okay, well, basically the land value is about $100,000. So that leaves the remainder $800,000. Okay. So then he takes the remaining $800,000. Remember, 39 years commercial real estate that you can straight line depreciation, you can write this off. So takes the $800,000, divides it by 39 years, come up with roughly, he can depreciate $20,000 a year, okay, over this 39-year period. What this means that if he sells it in 5 years, 20 times 5, it's $100,000, okay? If he does it without doing a cost segregation study, that basically he'll be able to keep from paying taxes on that $100,000. Follow me so far? All right, good. Now, he really wants to increase his depreciation expense, so doesn't have as much to pay in taxes, right? Orders a cost segregation study. They go in, the engineers, they complete their analysis, and they claim that they can take a quarter, 25% of the $800,000, 25% of the $800,000 that was used. So basically, went in, looked at it, and they said, hey, 25% of the $800,000 was used to pay for the interior fixtures and finishes. Now, remember, this is considered personal property. So as personal property, this can be depreciated over 5 years instead of what? 39 years, okay? Now, Dr. R does the math to see how much that will change the total depreciation expense over that 5 years before he sells. Taking in this new information takes the $200,000 and divides it by 5 years, right? Which comes out to be in $40,000 a year. Okay, so the 25% of 800,000 is $200,000. $200,000 divided by the 5 years, remember, is $40,000. That leaves a remaining $600,000, right? So 800,000 minus 200,000, that leaves 600,000 to depreciate over that 39 years. With that, $600,000 divided by 39 years, $15,000. All right, follow me? Which total $40,000 a year plus $15,000 a year. That's a total of $55,000 a year in depreciation expense the first 5 years that the property is owned. Now, you can take the $55,000 a year and he can multiply that times planning on holding it for 5 years, right? Now he can shield $275,000 from taxes instead of the $100,000 taxes. That's a big difference when it comes to knowing how to play the tax game, knowing what to do. So this is a very simplified example, but it basically demonstrates the core concepts of this cost segregation. You split the property value into the different IRS categories. You assign each of them the correct timeline, and then you simply get to benefit from the accelerated expense schedule. Again, I wish my accountant would have sat down and kind of talked about this to me. Back then, I may or may not have gotten it the first round, but I probably would have eventually got it. But, it is what it is. Now I'm teaching it to you, and hopefully you can turn around and teach it to whoever you want. All right, so let's talk about what it costs to get one of these studies. Typically, both the cost and the ROI, the return on investment of these studies, it's going to vary. It's going to vary depending on the property size. It's going to vary depending on the building type and some of the other physical characteristics of the property. I mean, there's a huge range. I searched online. I try to search for my area. I try to search nationwide. I got from anywhere from $5,000 on the low end to $25,000+ to complete a study. Probably more than likely, the bigger the project, the more time consuming it is, probably the higher the price. So the bottom line is this. If you're like me, you're a busy dude, you're a busy high income earner, and you don't have a lot of time to deal with tenants, and you don't want to deal with tenants, and the thought of owning real estate is really not too appealing to you, another option is something that I've been doing since 2016, and that's passively investing passively in real estate syndications. This allows me to create extra income streams, plus getting these tax benefits to reach financial freedom much quicker than your financial advisor is going to tell you when you're 70 years old. Now, all the different syndication deals that I've been in, they utilize this. They utilize the cost segregation, which makes basically the passive income that I get from these syndications, whether they come out on a month. So I got some of them that pay me monthly. I just got a distribution this week. It was monthly. I've got some of them that pay me quarterly. So this cost segregation, you're able to get the depreciation. The depreciation is a passive loss. The passive loss, it's nothing more than just accounting, just numbers. The passive loss that you get offsets the passive income. It zeroes it out, which means you don't pay taxes. Now, again, I've been doing this since 2016. I've yet to pay any taxes on any of my distribution, on any of the passive income. Try doing that in the stock market right now, right? Now, speaking of taxes, what I want you to do is check out this next video over here. I sit down with legendary CPA Tom Wheelwright, who actually has Robert Kiyosaki, Rich Dad Poor Dad author, one of his personal clients. He knows what he's doing. And in the video, we discuss the different tax loopholes that he helps his rich clients use to pay zero taxes. I will see you in the tax loophole video. See you there.